This is your market intelligence briefing, afternoon session. The market's emotional state today is crystalline. Fear has returned. The CNN Fear and Greed Index sits deep in fear territory, and this isn't the productive fear that creates opportunities. This is the paralyzing fear that precedes major moves. Volume patterns confirm what sentiment suggests. Institutional money is repositioning, not panic selling. The VIX spike tells us options traders are paying premium for protection. But here's what separates noise from signal. This fear is selective. It's concentrated in growth sectors, tech specifically, while defensive sectors show relative strength. This isn't broad market collapse psychology. This is rotation psychology dressed up as fear. Smart money recognizes the difference. Two moves define today's stock signal, and both reveal structural forces reshaping markets. Tesla's 8% decline captures headlines, but the real story runs deeper than quarterly delivery concerns. This sell-off reflects a fundamental repricing of the entire EV ecosystem. Tesla isn't just an auto manufacturer, it's the bellwether for the entire transition to sustainable transport. When Tesla falls this hard on delivery data, it signals the market questioning the pace of EV adoption globally. European EV sales have softened. Chinese competition intensifies daily. The infrastructure build-out isn't matching adoption projections. Sophisticated investors read this Tesla move as validation that the EV transition timeline was too aggressive, valuations too optimistic. The broader tech sell-off reinforces this thesis. When you see simultaneous pressure across Tesla, Nvidia, and Apple, you're witnessing a recalibration of growth expectations. The market is saying the AI boom is real, the EV transition is real, but the timeline assumptions were wrong. This creates opportunity for patient capital and warns leveraged growth investors that easy money in these sectors is behind us. Microsoft's relative strength amid this tech sell-off deserves attention. While peers decline, Microsoft holds ground because enterprise spending on AI infrastructure remains robust. This divergence within tech confirms our thesis. It's not anti-technology sentiment, it's pro-realistic timeline sentiment. Crypto markets confirm exactly what equity markets signal, and this convergence carries profound implications. Bitcoin's decline mirrors equity weakness, but the correlation tells a story beyond simple risk-off sentiment. When crypto moves in lockstep with traditional assets, it signals institutional money treating digital assets as part of their broader portfolio allocation, not as an alternative system. This is maturation, not failure. The days of crypto as a pure hedge against traditional finance are evolving into crypto as a component of traditional finance. Ethereum's underperformance relative to Bitcoin reveals another layer. Smart contract platforms face the same growth timeline questions hitting Tesla and tech stocks. The promised decentralized finance revolution is real, but adoption curves were overly optimistic. Institutional flows into Bitcoin ETFs continue, while altcoin speculation retreats. This divergence within crypto markets mirrors the selectivity we see in equities. Institutional money seeks established players, not speculative growth stories. Geopolitical forces amplify every market move today, and three developments demand attention. Federal Reserve communications continue signaling a higher for longer interest rate environment. This isn't just monetary policy, it's geopolitical positioning. A strong dollar serves American interests in ongoing trade tensions with China and provides leverage in European energy negotiations. Diplomatic weight. Middle East tensions escalate oil price volatility, but notice what's not happening: panic buying. Strategic petroleum reserves globally remain robust. Energy markets show concern, not crisis psychology. This measured response suggests sophisticated analysis. Regional conflicts remain contained. Supply disruptions stay temporary. China's property sector challenges continue creating ripple effects through commodity markets. Copper, steel, aluminum all reflect reduced Chinese infrastructure demand. This isn't collapse, it's normalization after decades of unprecedented growth. But normalization of the world's second largest economy touches every global market. The intelligence edge today connects four distinct signals into one unified thesis. What we're witnessing isn't market fear, it's market maturation. The speculative excess of the past 3 years is being methodically unwound. Tesla's EV timeline assumptions, tech's AI adoption projections, crypto's institutional integration pace, even geopolitical risk premiums all are being recalibrated toward more realistic expectations. This creates a two-tier market. Established players with proven business models maintain valuations while speculative growth stories face compression. Microsoft versus smaller tech names, Bitcoin versus altcoins, defensive sectors versus growth sectors. The pattern repeats across asset classes. Sophisticated capital recognizes this environment favors selectivity over momentum, fundamentals over narratives, patience over speculation. The fear and greed index may show fear, but institutional positioning suggests preparation for the next cycle, not panic about the current one. Here's the question that should keep you thinking. If today's sell-off represents realistic repricing rather than irrational fear, which sectors and assets are still carrying unrealistic valuations that haven't been repriced yet? If this intelligence served you today, comment the signal is clear below. Subscribe and I will see you tomorrow with the next briefing.